Up until this point, we've been building the foundations of accounting, but now we're moving into the next stage, the recording system. In the first 8 episodes, every time I've shown you a transaction landing in a T account, I've skipped a step. We need somewhere to write the transaction down first, in order, both sides together. If we write every transaction down straight into its T account and something goes wrong, well, months later, there's nothing to tell us what happened. What we need is a journal, a diary of the business, and let's call it a journal. Diary. Now, a quick reality check. Nobody's sitting down today writing hundreds of journals by hand, but every accounting system you'll ever use is doing this underneath. We're going to write it out once, because understanding journals makes it much easier to understand what the software is doing. The journal is organised chronologically, like a diary, because if something goes wrong, it lets us retrace our steps. It gives us the date, the accounts affected, the amounts, and the reason. It's your audit trail, it's your paper trail, it's your record of what happened. Here's an example. So this is an example of a journal for a cash sale that we received. First of all, we need a journal number, so there will be a number generated, journal 1. There will be a date. What's the date today? 31st of July, 26. This will be the bank account. Debit, credit. Debit 500. This is for a 500 cash sale. Date 31st of July. Cash sale. This cash sale made from a kiosk, so we credit cash, debit the bank, and the description is cash sales from, let's say, kiosk. From kiosk. This is a journal. One journal. So this is one journal for a customer payment received for a cash sale. Notice both footprints, debit and the credit, sitting together in one journal. It's a complete story of that transaction. And this description line matters. It's there for the future. So this is a journal, one complete journal. That's the journal. Now we need a ledger. And a ledger is a filing system. Once we've written down what happened in the journal, we can put each part of it, the debit and the credit, into their proper accounts in the ledger. Put the debit in one account and the credit in another account. Let's have 2 accounts. Let's have a bank account and a sales account. This is cash sales, not credit sales. So all we do, we take the entries from the journal, the debit and the credit, and put them in the ledger in their accounts. Debit the bank 500, credit the sales 500. We would also put the date here and the description. Every account gets its own place. The bank has its own account, sales have their own account, expenses have their own account. The ledger organises every transaction into the correct accounts, and the journal tells you why. Think of the ledger as a filing cabinet full of accounts. In a small business, one filing cabinet is probably enough, but as a business gets bigger, they often need to have extra filing cabinets, one for customers, one for suppliers, but they're still using exactly the same bookkeeping rules. We will cover those later on. But remember at the start I said nobody writes these by hand anymore. Xero does it. Every time you code a transaction, whether you enter it by an invoice, a bill, or you reconcile a bank transaction, Xero is creating journal entries underneath. It's recording the dates, the accounts, the amounts, and the supporting information. And it then posts that information into the ledger automatically. The software hides all of that. Most transactions are entered through invoices, bills, bank reconciliations, payroll, but occasionally you need to record something manually. And every now and then you might need to make an adjustment. When a bookkeeper says, I need to journal that, that's what they mean. They are creating a manual entry. It wouldn't otherwise have been entered. The journal tells you what happened today. The ledger tells you what the balance is on a particular account. That's the biggest conceptual difference between the two. If I want to know every transaction on the 15th of March, I'd look in the journal, the diary. But if I wanted to know how much cash the business has, well, I look in the bank account, in the ledger. But here's a question. A real business doesn't just have 2 accounts. It might have 50, 100 or even more. Bank, sales income, wages, rent, GST, loans. So how do we keep a filing cabinet with 100 folders in order? We don't just throw those folders in anywhere. Every business uses a structured system to organise them, and that filing system has a name. It's the chart of accounts. It's a master list of all the accounts the business uses, and it's not just random. In episode 10, we're going to open that filing cabinet properly and see how a chart of accounts is built. So the next time you log into Xero, other software providers are available, of course, and you see that long list of accounts down the left-hand side, you won't just know what you're looking at, you'll know why it's organised that way. We'll see you then.